Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Here we are with another episode of Black and White Market Chatter on Life Planning 101. Matt Urban and Aaron Kennedy with you today. Aaron, it's a pretty good day. We finally got some cooler weather. That's a good thing.
Yeah, there's water outside. There's stuff falling out of the sky I've never seen before. It's fantastic.
That's right. It's wonderful. So, it's good to see some changes. And I think one of the challenges going on in the markets today is we're not seeing changes, or we're still in kind of this pattern of uncertainty with the Fed. And we talk a lot about it. So, one of the things we wanted to bring to you today is, what are people buying? And I say people, I mean you and me, I mean companies, I mean institutions. There's people are on different levels, right? You're talking Harvard Foundation all the way down to the average person. And but there were some themes that you found when you started looking at that. What's going on?
When we're in times like right now of uncertainty, if you go listen to the news, read the news, wherever it is, lots of uncertainty and lots of fear. So when we get to this point in time, one of the major themes is buy the fear. Because as humans, we throw the baby out with the bathwater. Doesn't matter if it's good, bad, or ugly. We sell it all.
Yeah.
And some of that stuff being sold, it's a diamond in the rough. It's the great stuff. And, one of the bigger themes that we're seeing, especially with what's going on in the interest rate world, is buying distressed securities. Things that really look beat up, that are ugly, but have huge potential. And we're seeing that a lot in the debt world, especially in the private credit. You can go and get some fantastic deals. You're looking low double digits, 14% on the distressed stuff. It is a fantastic time to be buying.
Right.
Blood in the streets.
Blood in the streets. So when you think about the interest rates, right, so the safe rate right now, federal government, that's around the 5% rate on short-term stuff. So you're getting all the way out to 14. So there is a certain amount of risk you accept to get there, right? It's not the same as buying a CD at the bank or a brokered CD like we buy, but still there's a way to peel back and analyze that credit to see how quality it is, even if it's distressed right now.
Yeah, absolutely. And it's not, you nailed it. This isn't something that you want to go buy an ETF with. Probably not the best time to go out and buy a junk bond fund. You're just getting everything.
Right.
But if you have somebody that's willing to go sit down with management and go check out the properties or check out the factory, see everything, there is some great stuff that is just price wrong. Mm-hmm. And that's where you make the most money, is when you buy mispriced securities. And that's really, that's a real hot spot right now. What is priced too dang cheap for what's going on?
Well, and so typically, when you're getting started in something, and this kind of thing goes everywhere, you're willing to take a little bit more risk to get started. Like a business owner, you might have to take a little bit of higher interest rate loan to get started, because you're not Apple, who can get 30-year bonds at 2%, right? In the billions of dollars. So when you start looking at these interest rates, right, if you were able to get the 14%, that means somebody is paying the 14%. So there's companies out there paying it, so you go analyze those cash flows, right?
Right. You just see what the company's making. Number one is how big is the debt piece for the revenues or for the earnings, and if it's only 10%, they're only building one factory and they already have 10. It could be a very, very small portion of their overall revenue or earning structure. Mm-hmm. There's lots of different ways to look at it. And if we're looking at it from a risk standpoint, what makes sense and what doesn't? And if we just look at it as debt as our total cost of capital, we're not issuing stock, all we're doing is going to get a loan and using 100% of that to run my business. Well, it still may make sense at 14 if I'm growing at 14 and a half.
Right. Well, any positives.
Or 15. Because what's that debt going to be?
Yeah.
6, 7 years, I have a little bit tighter belt for 6 or 7 years, and all of a sudden, boom, I paid off my debt, and now I'm making 14 to 15% of my money.
Yeah.
Whoa.
Yeah, that's pretty good. Yeah.
We just have to be making more than our cost.
Right. Well, and you're seeing that, you talk about Austin and some of the projects that are happening down there, the big construction projects, and I know, I was talking to somebody the other day, it's like, if their capital project, just like you're saying, it's making 15, costing 12 to finance it, they're money ahead, they're steamrolling forward because they want something there when manufacturing opens back up.
Yeah. Think about being in your economics class and having to draw out all those simple charts, supply, demand, cost of capital, weighted average. As long as you're ahead, you keep doing it. You keep doing it until that becomes equal.
That's right.
And once it turns negative, you've better been stopped. But as long as you're making something, you keep going.
Yeah.
And, if you're looking at these projects, you can really dig down and find out which ones are going to be cash positive and which ones aren't. So it's a great time because everybody's scared.
Well, and you said it earlier, you're hearing a lot of the same things. And I think what we've seen over the last, you've had a better timeline than I, but we've been watching people throw darts the last 4 or 5 years, and they've just, whatever they hit, it seemed to have taken place. And really, since I guess that COVID crash was kind of the best illustration of that. You could have jumped on the back of anything and it would have taken you to the top. Now, some of that came down a lot quicker than others, but the point is that you didn't have to do the work. You didn't have to do the analyzation, and you didn't have to have people in your corner that could peel back the layers of that onion, right?
That's right. I mean, it was the total monkey throwing darts scenario. You make money doing anything.
Right.
That time's changed.
Yeah, it has. I heard something
it depends on how you look at it. If you're looking at it just from a stock standpoint, it's been extremely difficult.
Yeah.
But, company projections, company earnings, they're still holding on there. They're still making money hand over fist. It's just, it's not being recognized in the market.
Right. Well, and that's the mispricing that you're talking about.
That's the mispricing.
Yeah.
And, as long as your time frame isn't a month or a year, this is where it all happens. You just kind of wait for something to break, and then you go see if it's broken.
Yeah, right. Right.
Am I just replacing the tube or the car? I mean, on the tire of my car, or did I blow my engine? If it's just my tube, man, put it back on and let's go.
Go on about your day.
So,
yeah. Well, and that's right. And so thinking about some of these companies that we've had good earnings, and we have good earnings because people are spending. Right?
Yes.
So there's still cash flow there. Now, it's not across the board. And to kind of go back to it just a half a second, I was hearing something the other day, and they said it's really been a really tough environment for active managers over the last about 2 years because of those 7 stocks that made money. So it's like, okay, so we've been hyper-focused on one thing. But when we jump out of that fast lane and we start digging into what's going on with other individual companies, I mean, you were talking about it. They're buying things. They're moving things. They're selling things. They're paying wages. You know? So talk about some of the stuff that they're buying, because if they're buying stuff, we need to be buying stuff, or they need to be buying stuff.
Absolutely. One of the coolest things I've seen, energy market. Mm-hmm. Right? Just think of all the things that we've been hearing with the energy market. Think about the EVs and how that's going to drastically change, and that's going to way lower our cost or our need to own oil. It's supposedly it's over. Within the next year or two, everybody's going to be driving EVs, and the entire market's going to change. We're not going to need electricity. I don't know how that's going to work.
Except to charge
wind and solar.
Wow, okay, sorry.
Wind and solar, that's going to charge everything. But anyways, our reliance on energy is coming to an end. Well, there's some pretty big guys out there that are thinking to the contrary of that. And I think as today, Chevron announced that they're spending about $50 billion to buy Hess. No, I take that back. Hess was a $48 billion company.
Okay.
They're spending $60
There's
billion
$60 billion. Wow.
to buy
Yeah.
Hess. Exxon just bought Pioneer.
Right.
Holy cow. So, I mean, that was about a $60 billion too. That's $120 billion that these energy companies just spent. And you wouldn't do that if you think it's going away.
And so tell me, I don't understand as well the scale of those. So $60 billion company compared to, I know some of the other market caps are touching the hundreds of billions, trillions, whatever. Like, so talk to me about the scale. Are these like Hess and Pioneer, those the small, super small fish?
No. They're small, large caps.
Okay.
Now, they're not the $500 billion or so, and I don't even think Exxon's there quite yet. But that's a major piece.
Yeah.
If we're sitting at $400 billion and you just spent 60, holy,
that's a big percentage.
That's a big chunk of money. It's not just the producers. ONEOK just bought Magellan, and that's a pipeline.
Wow.
That's a major acquisition. You definitely don't do this if you think that industry is going away.
Right.
Or you don't do that if you think this industry is slowing down.
Right.
Because the big boys are going to take more and more market cap and just squeeze them out. So they're doing this for growth. They're trying to pick up as much production as they possibly can.
Well, they got their little chart out like you talked about, and the way the lines crossed, they were a little higher than negative, right?
Yes. And we've been preaching this all year long. Energy's big. Energy's huge. And we don't produce enough of it to do what we need to, or not need, or wanting to do. We have to have our utilities pumping out electricity.
Mm-hmm. Well, right now it's a lot of political risk too. I mean, I know we're not going down that necessarily route today, but the strategic reserves are extremely low compared to where they need to be, especially if we're on the edge of war. So
strategic reserves are super low.
So really thankful there's some of this capital being deployed.
Absolutely.
So we can try to get that fixed too.
Absolutely. And we're running into a part out in the Permian that, it's going to be harder to get growth out of the ground. I was talking to an engineer the other day, and he was talking about the interference of the lines. Basically, if you get one line too close to the other, this is very simplified, but we're robbing Peter to pay Paul. So we've been doing that. We've already sucked out almost 50% of everything that's under the ground. So that growth is gone. Interference rates are way, let's just say they're a lot bigger than they've been projected and even been talked about. So,
well, but those lateral lines are so long.
Yes.
And so you would think they start to drill that well, the well in the center, and it kind of spiders out now versus straight down.
Right. So how many other wells are you hitting? How many wells are you depressurizing?
That's a very interesting concept.
Yeah. So what's the easiest way to do it? It's not go out there and spend millions of dollars for a new well. You just go buy somebody else's. Hello, Hess. Hello, Pioneer.
Right.
Great plays. So, we were talking that earlier. If these companies are willing to be buying, we should be as well.
Right.
Because that's their lifeline. That's their family's wealth.
So the old saying of how you think about money, or how you talk about time, is how you think about money. And so these guys are talking about 10, 15, 20-year capital projects. And so that's where that type of return they're going to get. They're not talking about trying to get a return tomorrow or the next day. That's kind of the day trading stuff. And we know statistically that only works in very specific scenarios, right? It's not a good long-term investment play. So trying to get past this, they're looking 3 and 4 presidencies down the line, not one.
Right.
They're looking so far out in the future because that's where they're making those capital deployments to try to make some revenue.
That's right. And in any of these types of deals, these projects are all long-term just to get going.
Yeah.
look at the U.S., we've slowed down over the last, 7 years or so. And where did that put us? We lost our dominance in the world oil.
It didn't take long.
Growth. No, it doesn't take any time at all. And how many millions or billions of dollars is it going to take to catch up?
Right.
So you got to keep growing. Got to keep growing. And it's a great feeling to look out there and say, not everybody's the ostrich burying their head in the sand. People are taking advantage of it.
Yes. Well, it gives you that hope. So what else? You said there are some other industries too that are rolling out and buying stuff.
Yeah. So the acquisitions, mergers and acquisitions, we had a huge year in 21. It cut in about half in 2022. There should have been a warning seeing all the stuff going on, but this year is keeping up with last year. And, as the projections go, we're that 1 month closer to recession.
Sure.
So
Yeah.
these big companies are completely ignoring it. Some of the ones I bet a lot of people have heard of is No More Albertsons. Kroger bought them up. That was a $25 billion deal. And, grocery isn't a real high margin business.
No.
So you gotta have your math right to make money there. Let's see, Cisco just bought Splunk. That's another big one. More on the safety of technology, cybersecurity,
Okay.
that kind of thing. We already talked about OneOak. Broadcom just bought VMware. Even with all the AI stuff, companies are still ramping up, and things haven't gotten so expensive all across the spectrum that these deals can't take place. And if you think about it, we're scared of interest rates. A lot of these deals are all stock, all cash. So they've been making the money. They have the money, and the project makes sense, and they're going after it.
Right.
So super positive for the market.
Yeah. Well, it's amazing to have those deals and not be burdened with these interest rates for long term.
Yes.
Right.
That's exactly right. There is a big cost. So, if it adds, like we were talking earlier, a little bit more than 14% at the bottom line, you do the deal. But they don't have to worry about this. Especially on the Chevron deal that just went through is all equity deal. So, usually we see a huge misprice or repricing,
Mm-hmm.
and it's been pretty ho-hum, pretty boring today, seeing what's going on there. So very exciting stuff. And, we're not Chevron. We're not going out and spending $50 billion. But from the market perspective, we're coming into the fourth quarter. We've just shaved off, 7.5% since July.
Yep.
We're bouncing off some oversold levels. More than likely, we're going to have a very strong Christmas season. I can't see us going gangbusters all year long and then the consumer disappear for the fourth quarter.
Right.
Now,
You're going to keep showing up.
it's going to keep showing up. And there's a lot of companies out there that are on sale. Big time on sale. We're just looking at things from January 1st of 2022. Markets are still negative. This is 2 years of negative market.
Yeah.
So we're long in the tooth. It's time to get going again. And, if we can have the Fed stop trying to slow us down,
Right.
things are looking positive.
Well, and the great thing is, Aaron, so really since the end of 21 is kind of where you started pacing that dry powder back and putting something in your pocket for a rainy day, and some of that, it helped with some of the volatility through 22, but so in similar nature to these big boys that have cash on the side and equity deals, you're able to slice in and not have to use the quote unquote high interest rates by having to sell something that's down
Right.
to redeploy it. It's interest bearing stuff, cash, right?
Yeah, we're sitting in cash that's earning about 5.5%, and we're about to run out of time. Not really run out of time, but typically the Santa Claus rally, it begins November 1st. So, we're actively looking, where do we want to put our capital? And there's lots of places to look.
Yeah.
Lots of places to look. And even this year, the market as a whole is negative.
Yeah.
It's down 2% for the year. So there's lots of companies out there we can go buy and have a fantastic deal.
Yeah, and the prices are looking good, and really, if they can do it, why can't we?
That's exactly right. If they're buying, why aren't we? Because our time frame, we spend a lot of time on everybody. Is our time frame is the rest of your life. So if we miss it by a month or we miss it by 6 months, we're not even going to remember.
Right.
It's not really even going to affect us 5 to 10 years down the road.
That's right.
What will affect us if we never go back.
That's right.
Right.
Yep.
So
or get out at an inopportune time.
Right.
It's the big emotional decisions that you remember, but missing it by 1 or 2% here and there, it's not going to matter in the long run.
No, it absolutely will not. And like I said, we've been given another breath of fresh air just since the middle of July.
Mm-hmm.
Well, markets are down 7.5%. So let's get a better deal. Let's get a better deal than we did. And regardless of what happens in the news, regardless of the things that we see, market always climbs a wall of worry. And things will be better 5 to 10 years from now.
Yeah.
And more than likely, it's going to be a slow and steady climb upwards.
Yep.
Not year 10, we get all of it.
Right, not the bamboo plant.
Yeah.
Year 5, right?
And that's the way markets should feel. It should, I guess you could take this the wrong way, but it should be gut-wrenching most of the time. And then you just look back and say, good gosh, I didn't realize all that happened.
Right.
Because most people think it's a day-to-day thing, and it's not. It's not a month-to-month. It's years or decades.
Yeah.
And then, wow, look at what just happened. There's a pretty famous white curly-haired guy that said compound interest is one of the seven wonders of the world.
Yeah.
That was Einstein. And that's the way it works. We're not compounding on the day. We're compounding days into years and years into decades. And it's magic. It's all magic.
Yep. So pretty awesome stuff, Aaron. So, looking to get some of that cash to work and finding things to buy. So that's great news. I'm glad to hear that. And is there anything else? We're kind of getting long on our time. Is there anything else you want to say before we get wrapped up today or to close?
Lots of things are going on in this world, and a lot of them just simply don't make sense. So hug your loved ones. That always makes sense.
That's right.
Love your people and stay sane. Try not to get carried up in the craziness.
That's right. And if you have any questions about what we talked about today or just want to talk, love to hear from you. Love to talk with you and most of all take care of you, each and every one of you. So thank you for listening to today's episode and we'll be back soon on Black and White Market Chatter on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax, bookkeeping, and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group, LLC. Kennedy Financial Services and Smart Money Group, LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.